In 2025, Americans are no longer shocked by big numbers. They scroll past them the way they scroll past weather alerts that never seem to arrive. $15,000 in personal debt per person no longer sounds alarming. $38 trillion in federal debt feels abstract, like a number meant for economists and politicians, not for people buying groceries or filling up their cars. Even an annual interest bill of more than $1.2 trillion is treated as background noise, another line item in a government budget that has long since stopped resembling household reality. This is how structural collapse begins, not with panic, but with numbness. The original warning behind the coming 2025 to 2026 crash starts here. The problem is not a single market. It is not stocks, or housing, or banks in isolation. It is the fact that every major pillar of the American financial system is now carrying weight at the same time, and none of them are strong enough to hold it alone. Consumer debt, government debt, asset prices, and credit markets are all stretched to historical extremes, while the tools that once softened past crashes have already been used, and used heavily. The average American household today is carrying more than $15,000 in non-mortgage personal debt, spread across credit cards, auto loans, installment plans, and home equity lines of credit. That figure alone understates the stress, because it ignores the cost of servicing that debt. Monthly debt payments now consume well over $1,000 for many families, even before rent, food, insurance, or healthcare enter the picture. When interest rates rose, these obligations did not reset gently. They snapped upward. At the same time, the federal government is borrowing at a scale never seen outside wartime. With debt exceeding $38 trillion and rising, Washington now spends more on interest than it does on national defense. That is not a projection. It is already happening. And unlike past decades, this debt is no longer cheap. Each new Treasury auction locks in higher costs, permanently raising the floor under future deficits. What makes this moment more dangerous is that financial stress is no longer theoretical. Corporate bankruptcies have surged to their highest levels in well over a decade, and household financial strain is increasingly visible in missed payments, rising delinquencies, and emergency borrowing just to cover essentials. These are not warning signs flashing on trading screens. They are showing up in court filings, bank statements, and kitchen table budgets across the country. The crash narrative begins here, not with a market chart, but with a society that has quietly normalized unsustainable numbers. When those numbers stop being rollable, the adjustment will not be gentle. For decades, the American consumer was treated as an infinite engine. If growth slowed, households would borrow. If wages stalled, credit would fill the gap. If prices rose, financing would smooth the shock. That model worked as long as debt was cheap and incomes kept up just enough to maintain the illusion of control. In 2025, that illusion is breaking down. Household balance sheets are now crowded with obligations that were once considered manageable but have quietly become suffocating. Credit card balances have climbed back above pre-pandemic levels, but the interest attached to them has not. Annual percentage rates that once hovered in the mid-teens are now routinely above 20%, and in many cases closer to the high 20s. Auto loans, stretched over longer terms to keep monthly payments tolerable, have pushed the average vehicle balance toward $25,000. Home equity lines of credit, once marketed as flexible safety nets, are increasingly being used as last resorts to cover basic expenses. The key issue is not just how much Americans owe, but how fast the cost of carrying that debt has risen. Monthly debt service now absorbs a meaningful share of household income, even for families that would have been considered financially stable just a few years ago. An average monthly obligation north of $1,200 leaves little margin for error. A single job loss, medical bill, or rent increase is often enough to push a household from coping into crisis. Recent data show consumer delinquencies accelerating, particularly among middle-income borrowers who had previously been insulated from financial stress. Missed payments on credit cards and auto loans are no longer confined to the lowest income brackets, signaling that strain is moving up the economic ladder rather than remaining isolated at the bottom. This is a crucial shift. It means the shock is no longer absorbed quietly by the margins of the economy. It is spreading toward the core. Inflation may have cooled on paper, but the cost structure facing households has not normalized. Insurance premiums, healthcare expenses, and housing costs remain elevated, while wage growth has slowed. The result is a consumer who looks solvent in aggregate statistics but feels cornered in daily life. The American economy is still officially driven by consumption. What has changed is that consumption is increasingly financed by desperation rather than confidence. That distinction matters because desperate spending does not survive tightening credit. When lenders pull back, the consumer engine does not downshift smoothly. It stalls. When stress reaches the consumer, markets usually try to ignore it. Wall Street prefers narratives that float above household reality. And in 2025, that narrative has a name: artificial intelligence. The stock market's recent strength has not been broad-based. It has been narrow, concentrated, and heavily dependent on a small cluster of companies that investors have decided represent the future. Together, the so-called Magnificent Seven now account for nearly one-third of the entire S&P 500 index, an imbalance that would have been unthinkable in earlier eras, but is now treated as efficiency. This concentration matters because it turns confidence into a single point of failure. When gains are driven by a handful of stocks, the market does not need a systemic shock to unravel. It only needs doubt. Algorithmic trading systems, which dominate daily volume, do not evaluate long-term fundamentals. They respond to momentum, volatility, and correlations. When those signals flip, selling spreads faster than any human reaction time can contain. The original crash warning highlights this fragility clearly. Equity prices are not merely elevated. They are priced for perfection at a moment when the underlying economy is already strained. Corporate earnings growth is slowing. Margins are under pressure from labor costs and financing expenses. Yet valuations assume that innovation will outrun gravity. That assumption has historically ended the same way every time it has been tested. Recent assessments of market risk point to asset prices remaining historically expensive relative to income, cash flow, and long-term growth expectations. Even after bouts of volatility, equities have not meaningfully repriced to reflect higher interest rates or weaker demand. This disconnect leaves markets vulnerable to sharp, disorderly corrections rather than gradual adjustments. Margin debt amplifies the danger. When prices fall, leveraged investors are forced to sell, regardless of conviction. That selling pushes prices lower, triggering more margin calls, creating a feedback loop that feeds on itself. In previous cycles, falling bond yields offered a counterbalance, providing liquidity and stability. In the current environment, that safety valve is compromised. What makes this phase especially unstable is that optimism is no longer supported by resilience elsewhere in the system. The consumer is weakening, credit is tightening, yet markets remain priced as if none of that matters. That gap between perception and reality is not a warning sign, it is the fault line itself. If consumer debt is the slow leak and equity markets are the fragile ceiling, real estate is the load-bearing wall that is starting to crack. For years, rising home prices were used as proof that the American economy remained fundamentally sound. In 2025, that argument no longer holds. Housing is not strong, it is expensive. Those two conditions are not the same, and confusing them has been one of the most persistent analytical errors of the past decade. Nationally, home prices remain roughly 50% above their long-term trend, even after the sharp rise in mortgage rates. That gap is not a sign of resilience. It is a sign of imbalance. In many metropolitan areas, the income required to purchase a median-priced home now exceeds $120,000 a year, placing ownership out of reach for a majority of households. Transactions have slowed, affordability has collapsed, and mobility has frozen. This is not a healthy market. It is a stalled one. Residential stress, however, is only half the story. The deeper fault line runs through commercial real estate. Office buildings across major U.S. cities sit partially empty, relics of a pre-pandemic work model that never fully returned. Vacancy rates approaching 40% in some markets are not cyclical fluctuations. They are structural changes. Yet trillions of dollars in commercial real estate loans were underwritten on the assumption that yesterday's demand would eventually come back. Refinancing is now the pressure point. Loans that once carried rates near 3% are rolling over at 7 to 9%, dramatically altering cash flow math that was already strained by lower occupancy. Property owners who cannot refinance are being forced to sell into weak markets or default outright. Recent financial stability data show rising stress in commercial real estate loan portfolios. particularly among regional and mid-sized banks with heavy exposure to offices, retail space, and mixed-use developments. These institutions do not have the capital buffers of the largest banks, making them especially vulnerable to valuation shocks. Real estate has long been marketed as a stabilizing force in American wealth. In the coming cycle, it may do the opposite. As prices stagnate or fall, equity vanishes. As refinancing fails, losses migrate from buildings to bank balance sheets. The system does not collapse all at once. It transfers stress quietly, until the weight becomes impossible to ignore. The collapse of several regional banks in 2023 was widely described as a contained episode, a case of poor risk management rather than a symptom of systemic weakness. That framing was convenient, and it was wrong. What those failures revealed was not a one-off mistake, but a vulnerability embedded deep in the structure of American banking, particularly outside the largest institutions. In 2025, that vulnerability remains, largely unresolved. At the center of the problem is confidence. Banks do not fail because they are technically insolvent on paper. They fail because depositors lose faith. Once that trust is shaken, liquidity evaporates faster than any balance sheet can adjust. The Federal Deposit Insurance Corporation maintains an insurance fund of roughly $125 billion. That number sounds reassuring until it is placed next to the reality it is meant to backstop. Total U.S. bank deposits exceed $10 trillion, with a significant share sitting above insured limits. The gap between protection and exposure is not a rounding error. It is the system. Regional and mid-sized banks are especially exposed because they sit at the intersection of several stress points at once. They hold large portfolios of commercial real estate loans, they rely more heavily on local deposit bases, and they lack the scale, diversification, and implicit guarantees enjoyed by the largest national banks. When asset values fall and refinancing stalls, these institutions feel the impact first. Recent assessments of financial stability indicate that liquidity pressures and capital strain persist among mid-sized banks, even after emergency measures taken in earlier years. Unrealized losses on securities portfolios remain substantial, and exposure to commercial real estate continues to weigh on balance sheets. These are not hypothetical risks. They are measurable, ongoing conditions. The response toolkit is also smaller than it once was. In past crises, aggressive rate cuts and large-scale asset purchases restored confidence quickly. Today, inflation concerns limit how far and how fast policy can move. Emergency facilities may prevent immediate collapse, but they do not eliminate underlying losses. They merely delay recognition. Banking crises rarely announce themselves with drama. They emerge through cautious withdrawals, tightening lending standards, and a quiet pullback in credit availability. For consumers and small businesses, the effect is the same. Loans become harder to obtain. Costs rise. Growth slows. By the time panic appears on the surface, the contraction is already well underway. For generations, U.S. government bonds were treated as the ultimate refuge. When stocks fell, investors ran to treasuries. When fear rose, yields fell. That relationship underpinned every modern crisis response, from the Great Depression to the financial collapse of 2008. In 2025, that assumption is under strain. The bond market is no longer a passive stabilizer. It is an active source of risk. Federal debt has now surpassed $38 trillion, pushing the debt to gross domestic product ratio beyond 120%. Those numbers alone would be manageable if borrowing costs remained negligible. They have not. As older low-rate debt matures, it is being replaced with new issuance at significantly higher yields. The result is a federal interest bill that exceeds $1 trillion annually, a figure that continues to climb regardless of economic growth. This changes the mechanics of crisis management. In earlier downturns, falling yields provided immediate relief to borrowers, governments, and markets. Today, yields are rising under the weight of supply. The Treasury must issue massive volumes of new bonds to fund existing obligations, while investors demand higher compensation to absorb them. That dynamic weakens demand, just as issuance accelerates. Recent financial stability warnings highlight growing concerns about bond market liquidity and the system's ability to smoothly absorb large volumes of government debt during periods of stress. Even small disruptions in demand could trigger sharp moves in yields, transmitting shockwaves across mortgages, corporate borrowing, and equity valuations. The Federal Reserve is caught in a narrowing corridor. Cutting rates aggressively risks reigniting inflation and undermining confidence in the currency. Holding rates high increases debt servicing costs and tightens financial conditions across the economy. Quantitative easing, once a powerful backstop, now carries political and inflationary consequences that make it far less effective as a rapid response tool. The uncomfortable truth is that the traditional escape hatch may no longer open when needed. A market that once cushioned downturns could amplify them instead. If bonds fail to stabilize the system, every other asset class becomes more vulnerable by default. In that environment, volatility is not a side effect. It is the mechanism through which the system adjusts. When people compare the coming 2025 to 2026 downturn to 1929 or 2008, they often miss the most important distinction. Those earlier crises erupted when policymakers still had room to maneuver. Debt levels were lower. Balance sheets were cleaner. Confidence in institutions, while shaken, had not been hollowed out by decades of financial improvisation. This time, the system enters crisis already exhausted. What makes this convergence uniquely dangerous is that stress is no longer isolated. The American consumer is weakened by debt and rising living costs. Asset markets are priced for optimism rather than resilience. Real estate is trapped between unaffordable housing and commercially obsolete buildings. Banks are carrying unrealized losses while relying on confidence that can vanish overnight. And the federal government is financing itself at a scale that leaves little margin for error. None of these elements alone guarantees collapse. Together, they form a closed loop. In 1929, excessive leverage met a sudden loss of confidence. In 2008, financial engineering collided with housing reality. In 2025, the risk is broader and quieter. It is a system where every lever has already been pulled once, often twice, and where the cost of pulling it again grows higher each time. Stimulus no longer feels like rescue. It feels like delay. Recent stability assessments warn that financial risks are now converging rather than dispersing, increasing the likelihood that a shock in one sector rapidly propagates across the entire system. This interconnectedness reduces the odds of a contained downturn and raises the probability of a prolonged adjustment marked by weaker growth, higher unemployment, and sustained volatility. The most uncomfortable implication is social rather than financial. Retirement accounts tied to market valuations face the possibility of deep drawdowns. Job losses, once concentrated in cyclical industries, may spread more broadly as credit tightens. The idea that the next recession will be short and easily managed rests on assumptions that no longer hold. If history is any guide, the defining feature of this period will not be panic, but disbelief. The numbers were visible. The warnings were frequent. And yet, the scale of adjustment will still come as a shock. Not because it was unpredictable, but because it was inconvenient to accept. Thank you for reading, and let me know what you think about this topic in the comments below.